Hello and welcome to the show. Well, it is turning out to be a session where there is a slow and steady gain which is taking place in terms of the Nifty and the Sensex, and we do have the broader markets which are managing to outperform as well. So the advance decline ratio stands at a steady 2:1, over 2,100 stocks advancing and 1,300 stocks declining on the Bombay Stock Exchange. A similar type of ratio on the National Stock Exchange as well. As you can see, the advance decline ratio extremely steady in today's trade. But let's talk about a couple of companies then. Embassy REIT reported what was a decent set of Q4 FY23 numbers. Revenue and profit witnessed a jump of 16% and 27% respectively, while the EBITDA margin contracted. The company has also announced a leadership change. Arvind Maya has been appointed CEO with effect July 1st. Vikash Khadolia will be the outgoing CEO. Embassy REIT now joins in to talk more about these developments. In fact, we have with us Vikas. Vikas, thank you very much for taking the time out. If you could first just take us through the reason for the management change as well as the exit.
Sure, thank you. First of all, great to be back on the show. So, it's been an incredible 12-year journey for me with Embassy REIT now and earlier with Blackstone. So I think the time is right for me to pursue other interests. Having said that, it's been an excellent run on the listed company. We have built a solid business at Embassy REIT, and we have a great team in place. Arvind Maya, who will step in as the CEO, has been the CFO of the company earlier. And I couldn't be more proud of everything that the team has done. So I think I plan to dedicate more of my time to some of the other competing priorities that includes family, some new business interests, and fresh challenges. But all in all, I continue to stay as senior advisor to the REIT, and I'll continue to guide the team. And the business is in great shape, as you've said, on the Q4 numbers and the look forward. So I think it's the right time to pursue some of my other goals and priorities.
We look forward to hearing about your new professional passions. Vikash, hi, afternoon, Rima here. One change that we are seeing in Embassy's business model is a lower reliance on the technology, IT and IT-enabled services. And I think as a percentage of rentals, IT is now 15% versus, I think, more than 25% sometime back. Is this a trend that you suspect will continue? And how much do GCCs, Global Captive Centers, contribute to your overall rental portfolio?
Great. Thank you, Rima, for that. So absolutely, you're right. It's been a conscious strategy. So the global captives, as you're aware, they are these large global companies who are looking to set up in India. In fact, just last year, 100 of them set up centers in India. And the NASSCOM report expects another 500 GCCs to be set up over the next 3 years in India. So I think the global captives are coming into offshoring work and coming to India in a big way. And that is where we're seeing the demand come from. They also have higher propensity to pay. So as a strategy, we have shifted or pivoted towards global captives and large technology companies. And together they contribute about 70% of our revenues. And the IT services, while it still contributes a reasonable chunk of our revenues, has gone down from 25% to 15%. And that kind of shows in terms of our leasing numbers. We've done record leasing of 51 lakhs square feet this year. More importantly, we have added 44 new occupiers. Again, the same GCC occupiers, they continue to grow in India. And we are seeing that simply because India has this dual structural advantage, both of low cost and also abundant talent. So we continue to see this trend.
Sorry, I missed that number. GCCs contribute 70% to your overall portfolio now?
That is right, 70%.
And you are open for that number to go up from here on, as 500 more GCCs come in.
Absolutely. I think that's where the office demand is going. I think high quality landlords, occupiers want the total business ecosystem, which we can provide. And by the way, these are the occupiers who have the propensity to pay higher rents. So it's a great business for us to kind of ensure we cater to these clients.
Okay. So what is your project pipeline looking like going into FY24, and what might your targets be?
Sure. So, we are investing heavily in our organic growth simply because we can see those underlying trends, whether it's a recession, in the developed countries, we see more work being offshored to India. Simply these companies want to, be more efficient and cut on costs. So seeing this, we are, as we speak, doing a record 79 lakh square feet of new development. All of this is within our existing office business, within our existing park. So we are not going and buying land. The potential existed. We are investing about 4,000 crore rupees. And when fully completed, the deliveries happen in a staggered manner over the next 4 years. When fully completed, this adds about 900 crores to our net operating income. So I think it's phenomenal opportunity. We are investing in growth. We can see the underlying trends of demand accelerating as corporates start taking decisions towards the second half of this year. And we are very positive both on the India office story and also the global captives you mentioned.
But are you a little skeptical? Do you expect any kind of headwinds to this target simply because, there are layoffs which are taking place globally? There are fears of a slowdown now. And we are in a high interest rate environment as well. Rates might not increase further, but they might still stay high. In that environment, do you think that there could be headwinds to these targets?
No, absolutely fair question. So let me give you a perspective here on both these things. We think both of them are actually an opportunity. So on the layoffs, there has been exponential hiring during the COVID. And now we are seeing moderation in growth. And some of the corporates are doing what we call corporate housekeeping, which are resulting in layoffs. But this incident is far more prominent in the West. India has been relatively insulated. And we are seeing on the ground that corporates continue to hire for strategic roles. Let's say whether it's R&D, product engineering, or analytics. We see a lot of work coming to India, people being hired for that. I'll give you a small example of an American CRM cloud platform firm. They are laid off 10% or 7,000 of the global workforce in Jan. This is all public. And they have announced an India Center of Excellence where they are hiring 4,500 additional employees. So I think this is the trend. We expect to see more and more layoffs in the West will result in work being offshore to India, and India is pretty well suited for that. Now, let me come to the rising interest rates, and you're absolutely correct. The rising interest rates have impacted the global commercial real estate market quite dramatically. India has been a bright spot. Indian REITs have been fairly resilient. You've seen our Q4 numbers. What I think it will do, the rising interest rates, is it will also lead to rent inflation. And with rent inflation, we're already seeing Bangalore rents move 5 to 8% up over the last 2 quarters. And we also will see with the rising interest rates, supply coming down, diminished, which also gives us an opportunity because we are going ahead and doing the development and construction. So I think it will lead to consolidation. And we currently have about 2/3 of our debt at fixed. So we are somewhat insulated in terms of even the rising interest rate on our debt book of 15,000 crores. And we have one of the best credit ratings in the country. So I think all in all, yes, we are not 100% insulated, but we are very well placed to take advantage of the situation to the benefit of our unit holders.
So just to get some numbers on this point about how, while 2/3 of your portfolio and the debt that you've raised is fixed, you are still exposed to floating interest rates. So there is a note which says 4,100 crore worth of NCDs are up for refinancing. These were borrowed at 6.6%. And plus you've got floating rate debt of 5,700 crore, which will get repriced. Are these two numbers correct? And
that's
according
right.
to... Okay, so 4,100 plus 5,700. So we're looking at close to 10,000 crore. So now that the interest cost on this nearly 10,000 crore of liabilities has gone up, it could hurt your interest costs. It will push up your interest costs, and that could affect your payout. Is that something we should expect in FY24?
Yeah, so Rima, I'm not giving any guidance here, but your questions are absolutely fair. So let me lay out 2 perspectives. One, some of the debt will come up for repricing this year. We did a great job in managing our debt costs. We refinanced close to 6,000 crores last year, which resulted in pro forma interest savings. Having said that, as you mentioned, some of the repricing will happen. It's inevitable. But given we have a AAA balance sheet, rated balance sheet, we are only 28% levered on the company today. So we are very lowly levered. So we think we are well placed to access one of the best rates in the country. We have a very wide pool of investors in our debt book, from mutual funds to NBFCs. We have got listed bond investors. We have got banks. So I think we are well placed. But yes, this will go up. Having said that, I think there are multiple levers in the business. Obviously, the leasing spreads continue to be positive. So hopefully that makes up for some of the interest cost increases. And if I just take a step back, we look at our business, we don't manage it for a quarter or for a year. We look at it for the long term. So the way we look at the business is there are three priorities. Of course, manage the interest costs and ensure that the distributions continue. But more importantly, I think the leasing engine has to keep going on. We've done record deals this year. Over the last 7 years, this has been the best year. We want to continue that momentum. And two, we want to continue to invest in organic growth. We don't want to take a short-term view and just be far more defensive. We see it as an opportunity. Lastly, I want to mention on this point, it's a staggering number. We have distributed since our IPO in April 19, close to $1 billion in distribution, 7,800 crores. It's staggering given we had 2 years of pandemic and REIT is a new product. So I think hopefully the distributions are resilient, but we are very focused on growth.
All right, we're going to leave it on that note, and thank you very much. We look forward to your new endeavors as well as the new management coming on board. Thank you very much for joining in. That's Embassy REIT. Stock is holding up with a gain of around 0.5%. Time for a short break. On the other side, we'll be talking to the management of Supreme Industries, who will join it to discuss their Q4 performance.